Hi, Alasdair. Great to see you. Great to be with you on this rainy Tuesday here in New Hampshire. But I hope the weather's a little bit better in the UK.
Well, it's lovely to see you. Actually, it's raining here, but it is welcome. We've had such a dry spell. My lawn looks like the savannah in Africa, but I think it's slowly recovering.
Good to hear. Listen, we've got a lot to cover today. I'd like to start with this morning's CPI number, which came in above expectations. Do you have any immediate thoughts as to what the implications of it are?
Yeah, I mean, it's understating the situation. And I mean, everybody's got terribly upset. But I think the reason that they're upset is that everybody's been buying into this idea that the problem isn't inflation so much, but recession. And surely the Fed must, sort of go softer on interest rates because of the danger of recession. They seem to have almost dropped the inflation meme totally. I mean, when you look at inflation in this country, I mean, we were already talking about over 13%, and I think it was Goldman's are talking about 22% in the new year, possibly. I mean, inflation is not going away, and I think the reaction of the market, like a sort of 1,000 points off the Dow, was really a wake-up call. There are real problems here, and it's basically inflationary problems. Inflation, by which I mean rising prices, which are the product of earlier monetary policy, combined with Putin's restrictions on the supply of oil and gas. And I mean, it's a lethal combination, and that's what we have, and we still have it. And any idea that inflation is going away in the form of higher prices is simply wishful thinking. I mean, Putin isn't finished yet. I think in the winter, he's likely to turn the screws even harder. I mean, we could easily see oil at over $150 a barrel, easily. So it's not over until the fat lady sings, and she's not even got up to sing yet.
Yeah. So in your view, fighting recession is going to become more important than fighting inflation?
Well, we've got both things at the same time. I mean, anyone who's looked at inflations in the past hopefully understands that what it means is a transfer of wealth from the private sector to the government, and the private sector gets impoverished. And so the more they print, the more this is the case. And so you do not get, sort of continual and increasing economic stimulation from an increase in the quantity of money. No, that's only a very, very temporary effect. But we've got to the stage where not even that can help. Even in the very short term, we have a massive inflation problem. And it started off with COVID. Everybody thought that was a one-off. Now we've got energy. I don't know what Biden is doing in America, but in Europe, there seems to be a consensus that they've basically got to bail out all their citizens from higher energy prices. And not only that, but you've got a food crisis, which will be mounting this winter as well. Governments are going to be increasing their deficits, in other words, financing it by inflation, monetary inflation, to a huge extent. In this country, we're talking about adding probably another 200 billion on government borrowing. And goodness knows what it's going to do to countries like Italy and Greece, and I mean, let alone Germany, whose economy is also in a state of virtual collapse. This is very serious. So we've got this second bout of monetary inflation. And then we're going to have a third. And the third, quite evidently, is the result from higher interest rates to deal with the inflation. Because what happens then is that banks start, and I think we're already seeing signs of this. Banks are trying to withdraw from lending into an economy which is going down the tubes. And so if you take bank credit out of the economy, GDP falls. Why? Because all transactions are paid for through bank credit, one way or the other. And consequently, that then becomes a source for a new wave of inflation, because government deficits will rise even further, and governments will probably, assuming they continue to have this Keynesian concept of stimulating the economy out of recession, it'll probably chuck even more money at the economy, or currency, I should say, debasing the currency even further. So it's one thing after another. We're really on the path of hyperinflation. There is no other way of describing it. And I think that is becoming more and more apparent now to a wider and wider public. And of course, we know that it's not just a question of the quantity of money. If people start losing faith in the currency because they can see what's happening to it, then the currency is finished. And there's an increasing risk that that is actually going to happen.
Yeah, I agree with you completely on that. I learned from the 1970s, the actual experience that the only way you can fight inflation is to raise interest rates until you have a positive interest rate. In other words, after adjusting for inflation, you earn some interest income in real purchasing power terms. And what Volcker did is he raised interest rates so that the real interest rate was 6%, which is historically high, because normally in normal conditions, it would be about 1.5% to 2%. But what the saying was back then, it would draw money from the moon, or draw wealth from the moon. People would be so enticed to move into dollars that they would be worried about the future of inflation because interest rates were so high in real terms. And today, they've raised interest rates a couple of times, but we're still way negative. We're negative at least 6% in the United States, and probably more than that in continental Europe with the euro. So they can't be fighting inflation yet. And I put an interesting article in a news release from the ECB. They're fighting inflationary expectations. In other words, they want you to think that inflation is going to be less in the future, therefore you will hold the euros. But the proof is in the pudding. And until you get real interest rates, I don't see how they're going to stop inflation.
I would agree with that entirely. I mean, if in effect what Volcker said to the markets was, right, 19%. I think it was 20% prime rate. It was
21.
So 20%. He said, now, do you really want to duck 20% prime rate, 20% return on overnight money, or what? And that was basically the point that he posed to markets. And to that, of course, as you rightly point, it was so positive in real terms that the market said, okay, we'll go for it. But, one of the problems, I think, is until you get into that sort of situation, the idea that you can actually manage the rate of inflation by manipulating interest rates was disproved by Gibson's paradox. The problem was nobody quite understood why Gibson's paradox didn't work. But, I did a bit of work on it, and it was quite clear. And the answer actually was that the people who set the interest rates are not greedy savers, as Keynes reckoned, but it's actually businesses doing their economic calculations. What is it going to cost to fund or to finance this project? And can I make a profit out of it? And that would set the level at which business could bid up for savers' funds, because people aren't natural savers. They really aren't. They would rather spend it. So you've got to entice them, if you like, to save. So the idea that the central banks can actually control the rate of inflation by manipulating the rate of interest is completely bonkers. It doesn't work. It has never worked. And it's if you get a high interest rate, really what that's telling you is that people are not prepared to lend money at current rates in the current circumstances, because you've got the loss of the possession of money, you've got credit risk, and then you've got the problem, what's the money actually going to buy at the end of the lending term? And you put all those things together, that is actually what drives interest rates, and it is not the other way around. So I'm afraid there is absolutely nothing that the Fed, the Bank of England, the ECB can actually do to stop this inflation thing, other than control the quantity of money, which they are patently not prepared to do. I mean, politically, that's impossible.
Yeah, they're in this Keynesian rut that they blindly following this path, just like Japan, thinking that eventually they're going to dig themselves out of this hole, but they're actually digging it deeper and deeper and creating a potentially bigger problem when the walls start collapsing in on them. And I'm concerned that that's not too far in the distant future, but the outlook then, you agree with me, more inflation as far as the eye can see until we get real interest rates and control of reduction of the supply of money if that is going to happen.
No, absolutely. I mean, the article that I'm drafting at the moment for Thursday is, and that will be on Thursday, whatever the date is today. It'll be Thursday, the 15th, I think. Yeah. The article I'm drafting for that is really about this inflation and how it is progressing from one thing to another, and it just cannot be controlled by interest rates. And you can rule out any move towards making it positive, because that just bankrupts everybody. It bankrupts the governments apart from anything else. With what Zoltan Pozsar called, Bretton Woods 3, we're moving from that long-term decline in interest rates into rising interest rates, rising commodity prices. You get a contraction of paper equivalents, derivatives, and all the rest of it. Those markets are set to contract, not least because Basel III has actually partly recognized some of the risks inherent in banks having positions in derivatives. So I think what we've got a very major change in environment, and a lot of the problem, I think, for the political class in particular, who think, well, we can probably borrow for the next 15 years and pay it back over whatever. No, it's not like that anymore. I mean, I think you're going to see bond auction failures in future. And then you've got the position of what are the foreigners going to do with their holdings in dollars? I mean, there's something like 30, I think last time I looked at the US Treasury's figures, there's something like $33.5 trillion of foreign-owned financial assets and bank deposits. I mean, this is a huge, huge number. And when you get to an end of an era, which is really what we have seen with this turn in interest rates and this surprising, for some, rise in the rate of price inflation, what we have, I think, is a change, if you like, in the foreigners' attitude towards holding foreign currencies as well. So there's a lot ahead of us, which is going to be really quite difficult for the authorities to adjust to.
You mentioned Bretton Woods, and I read that piece that you wrote recently about the Asian Bretton Woods. Any comments on that?
Yeah, the thing that fascinated me was recent developments in Russia on the monetary side. I don't want to talk about anything else on that, but you have this guy called Sergei Glazyev, who's head of the Eurasian Economic Union Monetary Committee. And what he's been trying to do, and we've known this for a few months now, what he's been trying to do is to put together a trade settlement currency for any of the countries that want to join in with using something which is not the dollar to settle trade between them. And it's meant to be not just for the Eurasian Economic Union, but it's also meant to be open to members of the Shanghai Cooperation Organization, which will include China, India. I mean, we're talking about very populous countries, and also BRICS, if they want to join. And we had sort of an outline description of Glazyev's thinking, and he was talking about a trade settlement currency based on the national currencies of those involved, and maybe 15 or so commodities, which would be basically the commodities that they trade between them, all indexed in and then repriced out into individual currencies. Now, I mean, this is absolutely nonsensical. I mean, the man is an economist. He may not be as clever on monetary affairs as you and me, but nonetheless, he ain't a fool. And I would think that there's a certain amount of propaganda, if you like, in that statement. And then we have, out of the blue, Moscow saying that it wants to set up a new gold standard based on a new Moscow market. And, you sort of look at this and you think, hold on, and they're talking about other countries in Asia participating in this, like the Chinese, and again, members of the Eurasian Economic Union. Now, guess who's putting this together? Sergei Glasyov, exactly the same man who's been talking about this new trade currency. So perhaps I'm putting two and two together to make 5 or 6 or 7, but it does seem to me that he has probably arrived at the point which you and I would have started from, and that is an understanding that the only secure settlement currency that you can really have is gold, or gold-backed, credibly gold-backed. And so it does seem to me that that's the way they're going. And there's some very good reasons for doing that, because while we're destroying our currencies, Russia, China, and all the rest of them, I'm sure have an enhanced need to protect their own currencies from our misfortunes. So they will be moving towards some sort of plan B. So I think if you put the whole thing together, it is very likely that some form of gold-backed currency, now whether it's a trade settlement currency, whether it expands from that into national currencies, I mean, only time will tell. But I do think that in terms of getting away from the vicissitudes of fiat currencies, we're at last beginning to see a chink of light somewhere. It's just a pity it's in Asia rather than in our own currencies. But hopefully that will follow in time.
Yeah, well, Britain still has the British gold sovereign as the coin of the realm. It's officially the unit of account in Britain. So there's always hope that, Britain and the rule of law, English law is still the most common commercial law used throughout the world. Hopefully there's an opportunity.
Just a small problem, James. And, Gordon Brown sold most of our gold at under $300. But anyway, we'll pass over that one.
Well, you can provide the lawyers, if not the gold.
Yes.
Let's end it there, Alasdair. Great talking to you. And let's do this again in a not too distant future.
Yeah, thoroughly enjoyable. We must do that, James.
Sounds great. Thanks very much.
Thanks.
Bye-bye.